Welcome to this podcast with my friend and guest John Rubino, which I'm titling An Update of the Great Dollar Con Game with John Rubino. John Rubino runs the popular financial website dollarcollapse.com. He is co-author with Gold Money's James Turk of The Collapse of the Dollar and How to Profit from It. It's a great book, one that I've read and have in my library, and highly recommend you pick up a copy of it. He's also the author of Clean Money, that's Picking Winners in the Green Tech Boom, and another book, How to Profit from the Coming Real Estate Bust, and Main Street, Not Wall Street. After earning a finance degree and MBA, actually an MBA from the New York University, John spent the 1980s on Wall Street as a Eurodollar trader, an equity analyst, a junk bond analyst. During the 1990s, he was a featured columnist with TheStreet.com. He was a frequent contributor to Individual Investor, Online Investor, and Consumer Digest, among many other publications. He currently writes for CFA magazine. As many of you are aware, I have started doing some regular podcasts with David Jensen, who has done a remarkably good job, I believe, in uncovering the methods used by the money center banking thieves to manipulate the gold markets. And we've also talked on a frequent basis with Daniel McAdams, who provides a truthful account, in my view, of America's wars and how the U.S. is, in fact, destabilizing the world in many different areas of the world, at least. And both the work of David and Daniel, I think, are directly connected with the immoral acts of our ruling elite and explain to a great extent why markets are behaving as they are, and why the middle class is not only being destroyed, but led into slavery and losing their liberties as well. And just as David and Daniel help us understand the markets from their perspective, John Rubino also provides excellent insights into the interaction of global markets and how you can best protect and hopefully increase your wealth during these, despite these tumultuous markets. So I hope that you will take advantage of John's ongoing insights on his website at dollarcollapse.com. It's dollarcollapse.com. John writes frequent missives there that I think are very, very insightful. And also, of course, we do hope to have him on a fairly regular basis, perhaps every other week, to do a podcast at jtaylormedia.com. Thank you so much, John, for joining me today.
Oh, thanks for having me on, Jay.
Always good to talk to you. One of the themes that's really a big theme these days, and we've had Jim Rickards on this show, on my radio show, talking about it, currency wars, and you've written a lot about it. Going back to March 13, I'd like to just refer to an article you wrote titled Welcome to the Currency War, Part 18, Dollar Soars, Economy Disappoints. In that article, John, you talked about how the strong dollar was leading to poor economic statistics in the United States, and you made a prediction as to what that would lead to in terms of policy demands from the likes of Paul Krugman and other Keynesians. Can you share that? Share with our listeners the content of that article, if you would, please.
Sure. Probably the biggest story in the world of economics right now is the soaring dollar, which is, in one sense, really counterintuitive because the amount of debt that the U.S. is building up is on a really unprecedented scale. And normally when countries go really, really deeply into debt, their currency gets weaker. It's very much a cause and effect process. But in the case of the U.S., the rest of the world is in even worse shape than we are. And that's causing money to flow into the U.S. capital markets as safe haven. You know, they're looking at us and thinking, well, okay, the Eurozone might break up here at some point. China might collapse into a currency crisis. Japan is an absolute basket case demographically. So at least if we buy treasury bonds, we'll get our money back. So people are looking at return of capital instead of return on capital in a really risky global financial system. So money's flowing into the U.S., the dollar is way up, and that is affecting everyone differently, but everyone fairly profoundly around the world. And you've got, on the one hand, all the dollar carry trades, all the loans that are denominated in dollars in the developing world right now that are underwater because people borrowed something like $9 trillion in the last couple of years in order to do all kinds of things, build out infrastructure, make speculative bets, lots of other things. And basically, all of those investments or speculations are now underwater because the dollars that they borrowed are a lot more valuable, meaning they've got to
Right.
pay back a lot more real value to service those loans than they expected. And in the U.S., you've got equity markets and bond markets soaring because of all this new capital coming in. And at the same time, you've got economic distortions out there from weak currency in the eurozone leading to reasonably good results, or at least relatively good results, as their exports are cheaper now, so they can sell more stuff to the rest of the world, especially Germany. They're the ones who are really benefiting from a weak euro. And the flip side of that story is that the U.S., having a really strong currency lately, is seeing its economy slow down in a way that's surprising to economists, although it shouldn't be surprising. It's
Right.
just basic economics 101. When your currency gets more valuable, the stuff you try to sell to the rest of the world is repriced higher, and fewer people buy it. And so you see a slowdown in trade, which reverberates through the economy. Well, that's what we're seeing right now. U.S. manufacturing numbers are disappointing month after month. And our one big bright spot, which was hiring, in other words, more people were getting jobs over the last year, and everyone seemed to think that that would pull the economy out of whatever other statistics implied were leading to a slowdown. But the past month's hiring numbers came in about half what people expected, and then they went back and revised the previous 2 months' numbers lower as well. So not only are the jobs that we're producing mostly kind of crappy jobs, McDonald's or a
Right.
corporate temp job or a waiter in a restaurant or a bar, jobs that people don't really consider actual career paths, but just things they do while they're waiting for a job in their actual career to come along. We're not even producing that many of those anymore.
You're right.
Meanwhile, in the energy sector, in part because of the strong dollar, oil is way down. And we're seeing layoffs in that sector, which was previously the source of really good jobs. People getting hired in fracking, for instance, or in oil in general, they were getting real jobs. That was serious middle class money, and now those jobs are being reversed out, and so we're seeing layoffs across the board in the energy sector. So anyhow, add it all up, and the U.S. economy is slowing down a bit, in part because of the strong dollar. And meanwhile, the same thing is happening in China, which is the second biggest economy in the world, so it's very important what happens there. And their exports just fell out of bed in the latest report that came out this weekend. And, the economists had expected about an 8% increase in Chinese exports. And it turned out to be a 14.6% decline.
Wow.
Now, the general explanation for that is that China pegs its currency, the yuan, to the U.S. dollar. So when the dollar goes up, so does the yuan, and they're subject to the same basic supply and demand equation that we are. In other words, if their currency goes up, the stuff they're trying to sell to the rest of the world gets more expensive, less of it gets sold. Well, that should have been kind of basically clear to the economists making predictions about Chinese exports, because that's not a mysterious connection in any way.
Right.
You get that in the first few chapters of most economics books in college, and yet for some reason it was missed out there. And so now China, which borrowed about $15 trillion over the past 5 or 6 years, which is bigger than the entire asset base of the U.S. banking sector. It's a huge amount of money. They now face the potential of a credit crisis because a lot of what they spent that money on isn't working out for them. They've got these ghost cities, and they've got airports that see 2 or 3 planes a day flying in and out, and that's all, and empty malls and roads and bridges without much traffic, and none of that is generating the cash flow necessary to pay off the loans that were taken on in order to build them. And so they're slowing down dramatically. And so the U.S. and China both face the same problem stemming from a too strong currency, which is usually resolved with the same policy prescription, which is lower the value of your currency. So they're looking at some kind of a devaluation or quantitative easing or massive infrastructure spending going forward or whatever, some kind of a policy initiative that leads to increasing growth and a weaker currency. And so that's going to be a big deal, especially if China just breaks the link with the dollar and lets its currency fall. That leaves us all alone, and so this whole Fed meme of rising interest rates in the year ahead is already being walked back, but it's going to have to continue to be walked back until it disappears and is replaced by some sort of stimulus. So the rest of this year will be the process of that walking back happening, and then in 2016 we'll probably see a new QE or something else happen in the U.S. So we're going to see a big change in the nature of the U.S. policy response to the rest of the global financial system here. And now one wild card in all this is global capital flows because, as I said, the rest of the world is kind of a mess. And if it continues to deteriorate from here, while these other countries are aggressively liquefying their economies, they're pumping out huge amounts of new currency, but it doesn't necessarily have to stay there. The money that's being created in Japan or will be created in China could just as easily flow to the U.S. as people worry more about their domestic economies than whatever's happening here. And so we could see continued inflows of capital and continued increases in equity prices, even though they're at bubble levels now, and bond prices, even though they're at bubble levels now, while we're trying to respond to a slowing economy. So it's very complicated going forward. And the only thing you can say with certainty is that these currency exchange rates do have an effect and do prompt governments to respond to them. So we'll see those responses play out, but it's not clear whether it's going to take a financial crisis in the U.S. to get us to switch back from relative tight money to extremely loose money, or if it just happens due to the nature of the people in charge. They like loose money. That's their thing. And so they want to do it. They'll find an excuse to do it, and we'll have QE sometime in 2016 regardless.
It certainly doesn't seem like there's any possibility for interest rate rises or for tightening of monetary policy in the United States, given the scenario you just painted. Rising interest rates could. Then, John, do you think that there could be continuous flows of capital into the U.S., which would continue to strengthen the dollar, especially if China detaches, for example?
Well, yeah. See, that's the thing. If money keeps flowing in, keeps pushing up the value of the dollar, while the rising dollar is hurting us, do we have to get to some kind of a crisis point where we take really extreme steps in order to devalue the dollar, or do we just let it rise and live with the consequences? And the consequences are a slowing economy. Even while asset prices go up, the rest of the economy slows down.
Yeah.
And, this is really uncharted territory, Jay. We've never been in a place where everybody owes way too much money and everybody has a fiat currency printing press that they can just create as much new currency as they want to, and where the world is continuing to accept these currencies as actually of intrinsic value in some way. We've never seen this before. So this is an awful lot of stuff going on at the same time, each of which could be catastrophic or could be fine for a while, and there's no way to know. And so trying to manage money in this kind of environment is one of the ultimate nightmares. Yeah.
Yeah, it's really difficult because it's just hard to predict when the dam is going to break. We know it will because of because these are the direction of things. It's unsustainable, clearly, but when it's going to break. But you mentioned these. The dollar carry trade. So what you're saying is there's a huge number of people, borrowers of U.S. dollars at these low rates, that are now really in trouble, aren't they?
Well, you would think. We're not seeing a lot of reports yet from companies going bust and governments defaulting on their bonds and the kinds of things you would normally expect when a carry trade blows up. But there's $9 trillion worth of related debt out there that is suddenly 15 or 20 or 30% harder to manage than it was before, which means the return on all of these investments is negative now. And so you got to figure that somebody blows up as a result of these kinds of, in retrospect, unwise speculations, and that has a bigger or smaller effect, depending on who they are that blows up, on the rest of the surrounding financial system. And so we'll just have to see. You know, things have been blowing up for the last 5 or 6 years, and they've been diffused by easy money coming out of one central bank or another, actually for more than the last 5 or 6 years. If we go back to long-term capital management,
Sure.
and the Mexican bailout and the Russian default of the 1990s, you can say this has been happening for 20-some years now.
Right.
And where we've got a central bank put, basically. If something blows up, the central bank or all the central banks together comes in and creates enough new currency to paper over the effects of whatever bad decision the speculator or the bank made. And the current game goes on. So it's that we're seeing so many big potential blowups now. I mean, the oil sector has many trillions of dollars of debt that most of which is probably bad now because that debt was premised on $100 a barrel oil. Now oil is $50. And so cash flow is cut in half. And student loans, subprime auto loans in the U.S., we're seeing a lot of bubbles with a lot of malinvestment, any of which could blow up at any time. And so we don't know which will blow up first, but they're all out there waiting to happen.
John, given the the interrelationship with these the carry trade and the number of people globally that might be underwater borrowing U.S. dollars, do you think it's possible that the Federal Reserve could act ahead of time and start to massively do a QE4 or whatever to try to alleviate this problem? And also, there would be certainly it would be pressures within the United States to ease. Also with the weakening economy that you talked about.
Well, I think they would like to. Most of the Fed is
very dovish.
Dovish, because that's the general mindset of the guys in charge. You don't get to that point by being in favor of rising interest rates and therefore a slowing economy, because they see you as some sort of caveman who doesn't understand how modern finance works and who wants to put people out of work and who's heartless. People starve in the street. That's what sound money is interpreted as, in current Keynesian economics circles, and so you don't get there by being Milton Friedman, or somebody like that. You get there by being Alan Greenspan and Ben Bernanke, and so these guys would love to be able to just open floodgates and finance whatever needs to be financed, and convince people to borrow more money and spend that money, because that's how an economy grows in the modern world. And so you can bet that they're looking for excuses. So the question is, when do they get their excuse? Does the economy slow down further? Do the next few months of employment numbers bear out the whole layoffs in the oil patch and weakening corporate profits, therefore weakening corporate hiring, that kind of scenario? Do we get that in the next few months? And that would lead to, first of all, completely elimination of the whole we're going to raise interest rates this year.
Right. Yeah, I don't believe they will. Frankly, I don't see how they can.
Can you imagine what would happen in the global financial markets if the U.S.
started raising interest already with this imbalance that you talked about, with so many people being underwater with the dollar carry trade, and it's very frightening. But John, you mentioned the policy remedies are just completely wrong. The whole notion that that by printing more money we're going to get rid of unemployment, we're going to generate growth in the economy is clearly not borne out by history. It didn't work in the 30s. It's not working now. And the other thing that I think of is that they are utterly destroying capitalism, it seems to me, because if you take away price discovery from the capital markets, how can capitalism survive? So in fact, it's completely the opposite in my view. The policies ought to be rewarding savings and investment, but in fact is penalizing them. And I guess you and I agree on that probably.
Yeah. It's really important to understand that capitalism works as much through failure as success. You have to have big failures out there as an object lesson. It shows people how far they can go with leverage and aggressive expansion before it becomes too much.
Mm-hmm.
And so it kind of defines the limits of best business practices. And if nobody's allowed to fail, then there are no limits on how much risk you can take on. And that leads to what economists call malinvestment, which is money invested in things unwisely that don't generate enough cash flow to pay off the debt. So you get all this debt that's not being serviced out there, and the system eventually grinds to a halt, has a crash. That debt has to be gotten rid of before the sustainable growth can resume. And so historically, you have a business cycle. You have booms and busts that are completely natural because people are emotional. They get excited when things are good. They want to invest and make money now, and people overdo it, and then there's the malinvestment and the crash. Well, we've taken away the whole crash side of this, or at least we're trying to. We're telling the big banks, telling the big speculators that go ahead and ramp up your derivatives book to the point where you're systemically dangerous, and we can't let you fail anymore. So you can go ahead and reap the monthly fees from writing these new insurance policies, but you never have to pay off on the insurance, because the minute you do, if it causes you any trouble, we will step in and bail you out. So you, as a banker, as a derivatives trader, get to just write contracts as fast as you can write them, collect massive quarterly and year-end bonuses, and know that no matter what happens, you're going to be okay. If the global financial system gets into trouble, the government will just create enough new dollars to keep you going, and then you get to pay yourself an even bigger bonus for managing your company through the crisis.
Right, and this is just the immorality of the whole thing, John, because you're really hollowing out the middle class, redistributing wealth to the ruling elite. And, I thought it was very interesting because Michael Oliver, who is on I have on my radio show frequently and does some, I think, great technical work, was seeing in his work purchasing Chinese equities back in September, October. What a call. It's worked extremely well. But it seems to me that all Wall Street really wants is more of this juice to keep the redistribution process going, to keep them getting wealthier and wealthier. And I guess somehow, if they care at all, they're thinking that there's a trickle-down effect. But we're not seeing it. We've not seen it at all to speak of. I mean, maybe a little bit, but we're still not doing well. We've never, in my view, never have really recovered from the 2008-2009 decline. Would you agree with that?
Or
recovered to a degree, perhaps.
The financial markets have recovered.
Yes.
And so we've got a new...
But the real economy.
Well, there are fewer people employed in full-time good jobs now than there were in 2007. And that's really the main measure of middle-class health.
Absolutely.
How many people of working age, in other words, between 20 and 60, let's say, are working at good jobs? And that number is lower now than it was in 2007, which means we've spent, $10 trillion or $30 trillion or $50 trillion, however you define debt in our economy now, and gotten exactly nothing for it. We actually have fewer people working in good jobs.
Yeah.
And where do we go from here? Are we going to borrow another 10 or 20 or $30 trillion to try to get that employment number up? The idea behind Keynesian economic theory is that you pump up the economy with government debt, and then it takes off on its own. It becomes a self-sustaining recovery.
Escape velocity, as they call it.
Yeah, and that's what we're not seeing, especially based on the last few months' stats.
Yeah.
We've spent all this money. We've cut interest rates to historically unprecedented low levels, which that combination of lots of government spending and extremely low interest rates would, in normal times, ignite a rip-roaring boom in the real economy. You'd have people being hired like crazy. And our biggest problem, theoretically now, should be that too many people are getting good raises, And so we've got
but that's
wage
not
inflation
happening.
going. No, it is really not happening.
Yes.
And
Yeah, that's not happening, and it seems to me, though, here's the problem, that the Paul Krugmans of this world, the Ben Bernankes, the Janet Yellens, are not asking or not looking at the failure, at the policy failure. They just think they need more of it all the time. It's almost as if it's too threatening for them to even consider the idea that maybe Austrian economics has the answers and maybe Keynes is wrong. So the whole system, I mean, it reminds me a little bit of somebody in academia who's spent their whole life with a theory that is disproven and they can't handle the big lie that they
Well,
perpetuated.
that's normal human nature, right?
Yeah.
Once you adopt a belief system, it's really threatening to have to abandon it
All
and
right.
believe something else because it kind of invalidates your life up to that point.
Exactly.
So I get the fact that it's hard to switch gears when something doesn't work. And a lot of gold bugs are out there wrestling with this right now.
Well, exactly. And let's talk about gold a little
yeah,
bit, John,
okay.
because with this stronger dollar and what you're painting a picture of a stronger dollar, potentially this momentum continuing on further. I mean, there are people that sort of think maybe the dollar's topping out now, but what would cause it to happen unless there was a sudden change from the Fed? I don't know, but you also wrote an article on April 11th about the title was "What Gold's Bull Market Means for Miners," and I'm thinking, what gold bull market are you talking about, John?
Yeah, well, actually, Jay, this is based on some stuff that you explained to me years ago when I interviewed you for a magazine article.
Uh-huh.
And so I'll start at the beginning of the story. And basically, gold in the U.S. has been in a brutal bear market since 2013. I mean,
Right.
it's been down, and even when it ticks up, it gets smacked back down. And that is because in a floating exchange rate world, we tend to see the rest of the world through a lens colored by our local currency, right? Everything is
Right.
priced in the local currency, and those currencies are fluctuating against each other. So, yeah, the dollar being extremely strong lately means that gold is down in dollar terms. But if you look out at the rest of the world, you see that in almost every other currency, gold is up again. And after the 2013 correction, it has been steadily climbing. And in the last 6 months, in Canadian dollars, for instance, gold is up almost 10%. In British pounds, almost 8%. In euros, 17%. And in yen, almost 10%. So if you're in Japan or Great Britain or the Eurozone, gold is in a bull market for you as denominated in your local currencies. And so as Americans, we need to recognize how distorted our view of the world is because we're looking at the world through a dollar-colored lens. And realize that for most of the world, gold is fulfilling its function of being a safe haven when the government starts acting in bizarre and threatening and untrustworthy ways. In other words, when they start badly managing their currency, you move into gold as a place to hide out because gold holds its value over time, while a mismanaged currency goes down in value over time. So for the rest of the world, gold is doing exactly what it should do given the amount of debt that their governments are taking on. So in the U.S., that's where we're the anomaly because we continue to take on huge amounts of debt. The little tiny deleveraging that we had in 2009 or 2010
Yeah.
is over. And we're back to borrowing aggressively almost across the board. The government's still running deficits. Corporations are racking up huge amounts of debt in order to buy back their shares.
Right.
They're doing financial engineering rather than investing in new factories. Individuals are taking out subprime loans to buy cars, and students are maxing out their student loans now. Those are both trillion-dollar markets, car loans and student loans now. And you would think, given this rapid increase in debt, that we would interpret that as the government mismanaging the currency and shifting to gold. But it's not happening because the dollar is being bid up by the rest of the world right now because their problems are worse than ours. And so we're seeing international capital flows into the U.S., and it's pushing up the exchange rate of the dollar. But, of course, we're feeling the effects of that, too. It slows down your economy when your currency gets too strong. And so at some point, we have to reverse that back out. And then gold will start behaving as it should behave in the U.S. When the dollar starts to fall, gold will start to spike.
Well, I guess the big question in my mind is what would cause the dollar to fall now, and what would cause gold to rise. Also, the gold is functioning as it should in most countries and against most currencies, but it is also true, though, however, John, that you would have done better buying dollars than gold if you lived in Japan or Europe or someplace, at least for now. So, but diversification, I guess, is an idea that makes a lot of sense, because at some point in time, something's got to give here. With the picture you're painting, this is an unsustainable direction that the global economy is heading into, and so at some point in time, something's going to give, right?
Yeah, and so it's just a question of what does give. For instance, if the dollar goes up from here, and we're already seeing weak corporate revenues because our corporations aren't able to sell as much stuff overseas when their stuff is priced in dollars, that's one catalyst. I mean, how much further down can corporate profits go? Can they shrink? They shrunk in the fourth quarter in the U.S. Can they shrink in the subsequent 2 or 3 quarters? Mm-hmm. Without that really coming back to bite us? Because when corporate profits are falling, they hire fewer people. That's one of the ways you deal with falling profits, is you adjust your labor force to this new reality of narrowing margins and falling sales. And so if people are being laid off by big corporations, how much of that can we take in a system where, as we talked about, the labor market is already a lot weaker than the top line number makes it seem? And at what point does that force us to adopt a policy that pushes the dollar back down at whatever cost it is? And even if a lot of new capital is coming in, we still have the ability to lower the value of the dollar just by being really aggressive with monetary policy. Of course, that's an interesting story in its own right, because how do you implement an aggressive monetary policy when your interest rates are already at 0? And what do you do then? Do you go to negative 3%?
Yeah. Well, that's what they're doing in Switzerland. Yeah. In Switzerland, it's a negative interest rate already. And so, one thing for sure is it's becoming, while the short term, maybe the policies reduce the risk in the short term, what they're doing, in my view, John, longer term, is increasing the systemic risk of the entire global economy. And one very interesting chart I saw recently, this past weekend, showed the Dow to gold ratio, was on a chart from 1913 on, and the volatility of that ratio, the Dow to gold ratio, has just skyrocketed since then. So that tells me that the global economy and the potential for gold to rise dramatically against stocks, it's likely to swing back in that direction. So to me, John, what I think you and I both agree on is that people need to prepare themselves by diversification of their portfolios so that they have at least a certain percentage of that portfolio in time-honored money, in intrinsic money, namely the markets have always chosen them when they were free to do so, gold and silver, right?
Yes. Oh, and Jay, we started this segment with a mention of the mining stocks and the impact of what's happening out there on them. And they're an important part of this equation too, because and this is what when I mentioned you explained something to me years ago, this is what you explained to me, that mining stocks, gold mining stocks, actually do better in a time of deflation if their costs are falling faster than the price of gold. Right. And that and so you can compare commodity prices to the price of gold and get a sense of what the environment is like for miners. And right now it's getting more favorable because the price of gold for miners that are outside the U.S., they're getting paid in many cases in dollars for the gold they're selling overseas, but they're paying their domestic costs, in other words, their workers, in a depreciated local currency. So the gap between what they're getting, so gold is up for them. The selling price of their product is up, while their costs, especially oil, because the price of running those big earth-moving trucks and all the other stuff that is involved in mining, it's very energy-intensive business. That price is going down.
Yeah,
While
absolutely. And as you mentioned, John, I think you said 10% in Canada, 8% in the UK, 17% in the euro, and 10% in the yen. Well, obviously, Canada is a big mining country, and certainly the companies that I follow that have their operations there are definitely benefiting from the dynamics that you just mentioned. We do need to wrap it up now, John. Any other thoughts that you might have about what should people be watching now, and what do you think you might be writing about so they can keep up with what you're doing at your website at dollarcollapse.com?
Well, a big immediate story is corporate profits. Watch the earnings reports that come out in the next couple of weeks, and see first of all whether they meet their revenue targets, not their earnings numbers, because those are very easily manipulated. But
Yeah.
revenue is harder to mess with, and see if their sales come in at target or above. And
Uh-huh.
if they don't, if they undershoot their sales targets, then that is the scenario that we've talked about, where the stronger dollar hurts overseas sales, and that reverberates throughout the corporate sector. So look for that, see what
Okay.
happens, and that'll tell the tale.
Good advice, and I'm sure you'll be writing about it at dollarcollapse.com, right, John?
Yes,
No doubt. So,
definitely.
all right, great. Well, thank you very much for spending your time with us today, and I look forward to talking to you again perhaps in a couple of weeks.
Great.